So John, I want to pivot a bit to you and your background. I get the sense that, quite frankly, you're exactly the kind of guy that I would see doing very well at any of the bulge brackets. And I gotta ask, like, coming out, building your own fund, it's an entrepreneurial endeavor. It's not without risk in itself. So I gotta ask for, like, why? Why set up your own shop when you can do very, very well at the KKR-ish firms out there?
Well, I appreciate that, Alvin. Honestly, I've never worked at a bulge bracket. All my life I've been spent on smaller firms, more entrepreneurial firms, firms where when I had to build a model, I was starting from cell A1 in Excel and not something already templated where I just had to fill out numbers. I think for me, what I see with larger firms is a lack of hunger, really, and what I call institutionalization,
Yeah.
where a lot of these managers, a lot of the incentive to do well is based off of AUM and the fees, rather than actually generating good returns for your LPs. And that is, I think, what sort of pushed me out to start my own fund, which is if there are great opportunities out there in something that's undercovered, and I looked around and said, hey, somebody's got to do this.
Yeah.
Right. And I realized, hey, that somebody's got to be me. That's really what drove me out to do it, was the opportunity that I see, the opportunity to make great returns for my LPs. Whether the fund is big or smaller is not an idea, is not a thought in my head. It's rather going after this undercovered opportunity that nobody else cares at or looks at or understands, where we really have that advantage of understanding the landscape, understanding how to do these deals. It's the first time in my investing career where I actually feel like, wow, there's actually an edge like that I can look at and say, wow, it's actually there. Like, this is my edge and it's clear as day. And let's go execute on it. And seeing that play out firsthand in the deals we do, that is enormous for me.
I love it. I love the energy. One of the biggest challenges for managers coming out, and I remember when I was doing VC work, it's a tremendous amount of effort going into execution phase, due diligence. And what I imagine is in some of these larger firms, and perhaps even previously when you're at Industry Ventures, you had entire teams working on deals on a case by case, and now you're looking at it on a portfolio level. So I guess the question I have in my head is, how are you going to translate all of that heavy lifting that was done at the big shops into a startup like yourself?
Well, one is the way we invest is very scalable. So we're not looking at a new company every time we make an investment. We're not looking at a new fund every time we make an investment. We have call it 20 to 50 companies that we have underwritten and know is our target. And then our goal is to find avenues out there in the secondary markets to get them at the best price we can. So whether that's in an LP interest, whether that's direct, whether that's in a special situation,
Right.
guess what? We've already underwritten the company and it's just about execution
Right.
from there. So from that perspective, it's not that much of work. I think what's really important is understanding what kind of diligence is important as well. In the public markets, you can do 1 hour of diligence, you can do 100 hours of diligence. Guess what? The stock is either going up or down.
Yeah.
Not to oversimplify things, but there's diligence that covers 85% of what you need to know and work that doesn't. And having that experience across publics, privates, early stage, and my last firm, I think really helps me to identify, okay, what's really important here, right? Having operated in this space. And when I look at an LP interest or a special situation, I realize, okay, the revenues are most important here. Or no, actually, it's the deal structure that's most important here. Or actually, in this case, the upside doesn't even matter. We want to protect our downside through collateral in this case. Or different situations, you're aiming to maximize and minimize different risks. And I think that's the most important thing, is not so much diligencing the asset. What's its CAC, what's its ARR? While those are important, a real manager across any asset class, the most important job they have is to manage risk and to decide, okay, in this specific situation, is the risk worth it? And is it the right risk to be taking? Rather than just, is this a deal we can do? Yeah, for this reasons. You really need to ask yourself, why should I be doing this deal at this time? And that, I don't think, takes an entire team of 100 people.
Yeah. I imagine that one of the advantages that you have is you get to tap into the same network that you did at your previous shops, but in a leaner environment. And does that translate well, actually? Like, does the network translate
Yes.
well from the large shop to your business? And I ask this because a lot of the hedge fund managers that I work with who start and they have access to flow, they access to entire teams on the prop trading desk. It's a huge ecosystem.
Yeah.
But then once they come out to trade as an individual, as a startup hedge fund, they're kind of flying blind because they don't have access to flow, they don't have access to as much research. Is this not necessarily the case with VC private equity?
That's not the case in the sense of VC secondaries, especially how we do it. In many ways, remember the dynamics in this market is there are a lot of people who need liquidity and not a lot of people who can provide it. So us stepping forward to the table, we provide a service to GPs and LPs. So they are very happy to work with us, even if they're working with my prior employer or other secondary firms. Because again, like I said, 9 out of 10 LPs in their funds are small. And these large secondary firms aren't servicing them. And it's typically your smallest investors in your fund that are the sharpest thorn, right? So for a firm like us to come by and say, hey, we do the small things, we can help clean up your fund, right? Align it so there's not any small thorns in your butt. That's a really big service to GPs. And they like working with us and they like sharing with us proprietary deals and helping them clean up their cap table, as I say. What's really important in our space, more so than the network too, is speed and certainty of close. Anybody who's operated in this venture secondary space for like over 6 months will tell you there's a lot of fake supply.
Right.
There's a lot of brokers representing brokers. And there's a lot of sellers that are without capital or say they can buy it and don't show up. It's like the Wild West, and you never really know who you can trust. So in the secondaries space where we can come up to a GP or an LP, and when we write an LOI, provide them high certainty that we're going to close and fast, it's really important to them, right? Because liquidity needs change all the time. You're an LP in the fund, you need to sell something and raise $5 million because you're facing a liquidity issue somewhere else in your portfolio. And you need to solve this problem now. So you can't wait a month, you can't wait 2 months. You need a firm that can come by, underwrite quickly, execute quickly, and get you the liquidity you need. That's where our edge comes in as well.
Yeah, I think that makes perfect sense. I mean, whether it be property market or privates, it feels like, especially if you're dealing with institutions, they need to know that they're not dealing with the Mickey Mouse shop, right? I mean, even some of the family offices, they don't really understand some of the dynamics of structuring or deals, or they might not even entirely be sincere. And so a lot of wasted time, deals fall apart as a result. I would imagine you could potentially you might even be able to demand a better price or even a further discount just on the basis that you come from a credible background.
Yeah, with one of the deals that we did for our LPs, we were actually chosen to buy the portfolio, even though we weren't the highest bidder. But that's because of our reputation and our certainty to close. And they're like, yeah, we're willing to work with these groups where the price isn't as high, but we know it's going to close because of how, Mickey Mouse shit this industry is. Yeah. So yes, that is very important. Yeah.
How supportive is the family? I mean, you're coming out on a limb here. It's still an adventure and it's still an entrepreneurial endeavor, right? It's serial as it may be. Most startups don't make it out the first couple of years. How's the wife? Is she supportive?
Very supportive. The son is 3 years old. He doesn't know what's going on yet, but he's definitely supportive.
Congratulations.
No, thank you. Now, it is definitely a challenge on the family, right? And I think a lot of emerging managers and old managers told me, right? When you go out, it's hard. It's not easy, right? And fundraising is not going to be as simple as you thought it was. You understand it, but then when you really walk the walk, you realize, these guys weren't lying. This stuff is challenging on your personal life, on your professional life, and right, because you're trying to build something that wasn't there in the past, and you're trying to convince people of an opportunity that they never saw before. Yeah. And maybe they know who you are, they don't know who you are. So you really feel like a one person fighting against the world in many cases. But I'm lucky, right? I have a very supportive wife, a very supportive child. I have 2 venture partners who are very supportive and have taken a lot of load in terms of, responsibilities in building this firm. So we got a good team. We have a good network. We've sort of established our reputation in the industry by doing a couple deals and showing that we can move fast. We can get access to at good prices, at good assets, and we have high certainty to close. So that's really, really helped getting those proof points underway and showing that, hey, we're a real shop and we're here to stay.
If you were to talk to yourself 10 years ago, knowing what you know now, what advice would you give to that younger Jonathan Ting?
Look, I've thought about this before. Not that I would give advice, but looking back now, I've realized that the culmination of my life really has come to this. And the space that I'm operating in, venture secondaries specifically. I've seen investment banking, I've seen publics, I've seen early stage venture, late stage venture. And what I've realized is everything, even my personality, my demeanor, how I evaluate situations, it all comes down to this, right? There's a different asset classes and how you invest in them require a different sort of risk profile or way of thinking, right? Distressed debt investors won't do good in quant shops, right? Real estate investors probably won't do good in commodities, right? It takes a different kind of personality to be able to really love this stuff and to be in it and enjoy it. And I think venture secondaries is really that way for me. So no regrets at all. This is definitely the path forward for me and what I was kind of destined to do in this industry. I was really lucky to have stumbled across venture secondaries because, like, again, I realized this is my life's calling, is this sector.
Look, I'm pretty excited for you, Jonathan. And for what it's worth, we really want to see you succeed and hope to see you out here in Asia, hopefully better deals in the future. You're launching this summer, right? So congratulations, good luck. And yeah, we'll see you soon.
Yeah. Thanks, Alvin. Appreciate it.